Here at Post 9 today is Jefferies equity analyst Randy Konik. Randy, welcome back. Good to see you.
How are you?
Before we get to the just buy it part, what do you do about China if you're Nike right now?
Look, I think what the market's missing about Nike is the company is making progress where it is distorting resources and time and effort, and that's in North America first and running. The company talked about China on their call last night to say, look, we're going to focus on China next. They have a pilot program going on right now with a store and a couple stores where they're resorting and resetting the assortment, and that's starting to work, but China is going to take time. I actually think China will start to bottom in the next few quarters, and we'll go on from there. But, you know, the focus on the market today should be about the progress in North America, which is a very good positive green shoot for the business.
Right, we'll get to it. But what is the problem in China right now? Is it about merchandising? Is it about order books? Something else?
I think it's about the economy over there. Generally speaking, we're seeing most companies that produce or sell into China are having difficulty. So it's not Nike's fault. The consumer in China is more price sensitive, and Nike's having to deal with that. In addition, Nike has to kind of reset the playbook in terms of product, and they're going to do that, and it's going to take time. Look, we think it takes another 3 to 4 quarters in China to fix, but you know what? In the near term, North America is really getting better, and that should be the focus right now. Investors should buy the stock today, looking at for 2 years from now, which we think we'll see earnings per share start to rally back from where they are today.
Some of your competitors concerned, at least in a note, about their strategy of putting product in front of the consumer now in terms of the widening gap between direct-to-consumer and the wholesale channel, and maybe they're flooding that channel, and it's going to mean a tough 26. How do you see it?
Yeah, look, I think what's encouraging is that the sell-through rate in the new products in running are working well. And if you look at the direct channel distribution, the reason why it's lagging the wholesale channel distribution is they changed the pricing architecture and the promotional architecture in that channel of distribution, meaning they're being less promotional. And being less promotional is creating a lower sales growth rate for that channel of distribution. So I actually think it's becoming a healthier channel for the company. You combine that with a more balanced distribution with wholesale coming back, I think it actually says this company's doing the right things as we look over the next 12 to 24 months.
How do you assess the competitive posture at this point in time? One of the reports I was reading with regard to China said that the consumers there favor some kind of niche brands that play into specific attributes of the shoes and of the other products. Is Nike really leaning in and in a good position to gain back some share?
Look, China is a big market. It's a great long-term market, and sport's going to become even more important in that market. Nike is doing a good job of, look, revenue trends aren't a disaster. They're down 16%. They did slow sequentially from the last reported quarter, but they're not truly terrible. I think what we're going to see going forward is the company just reset the marketplace. It takes time, and with that, fruits of that labor will come through. We've already seen it in North America. We're seeing it in EMEA. We will soon see it in China. So obviously I see why the stock is down today because of China. But if people really think about the forest from the trees, they see China will bottom out in about 3 to 4 quarters, while the North American business and the EMEA business start to accelerate from here.
Tariffs taking as much or more than 5% out of gross margin. Yeah. When does that start to abate?
Well, look, I think another good aspect of the quarter is when they talked about North America gross margins, they were down 300 basis points, but tariffs were impacting them by 500 basis points. So what does that tell you? It tells you that the gross margins in North America have inflected. That's a big deal.
No, it is.
So,
when are they going to even benefit more? I mean, at some point, I would assume you lap these tariffs. I don't know.
Well, it's really good for Nike and the rest of companies in 2026. They start to lap these incremental cost pressures starting in the second, mostly in the third and fourth quarter. That's a big deal. So if you kind of add all that up together, you have Nike having the easiest comparisons in consumer discretionary. We're going to see these China terrible numbers get better and bottom. And we're going to see these tariff pressures abate as they lap comparisons in the second quarter next year. That's why you want to buy it today. And actually, if you look at the valuation, the market cap of Nike, this is the most ubiquitous brand in the entire world, trading at a market cap of less than $90 billion for a business that does about revenues of, at retail, about $75 billion. That's really low. You got to buy this market cap at these levels today.